Hi, I'm Rubin, your financial advisor, and I'm really excited to deliver you the great news of 2013. Now, 2014, when I'm recording this, it's been a little rocky, but we don't know what the future is going to hold, so let's go ahead and see what happened. With 2013 in the books, let's take a look at a couple different themes for today. And the first one is why timing the market doesn't work most of the time. And the second thing we're going to talk about is making sure that you're in the right portfolio for you and understanding what we can control and what we cannot control. Let's take a look at how the stock markets did, both US and internationally. As you can see, there are a lot of green arrows going up, which is a good thing. So, the US, again, the large, did very well, at least up 10% in both the blended and value categories. The US small cap stocks also did well. The US REIT's the only asset class with a downward arrow, again, ever so slightly, and again, because it is modern portfolio theory, certain parts are going to move up while certain parts move down, and that's okay. International stocks, again, up, not as much as the US, which kind of was the theme for all of 2013. And then the bond funds up ever so slightly, which is the purpose of short-term, high-quality asset classes, that to kind of bring some stability to that portfolio. So even the market's going way, way up, again, we'll have some slow growth in those bond funds, and when the market's going way, way down, we'll have slow growth, again, possibly even slight losses in those bond funds as well. But again, important to have them to dampen that volatility. With 2013 in the rearview mirror, let's take a look at the best and worst performing stocks of the year, just to make sure that we still believe that past performance does not indicate future results, which it never does, of course. Now, as we can see right off the bat, the number that jumps out to me is that Best Buy in 2012 down almost 47%. And then in 2013, the second best performing stock of the S&P 500. Just incredible. And if we take a look at Teradata, down at the bottom of the list of the worst of the S&P 500 for 2013. In 2012, it wasn't a bad performer at all, up 28%. In 2013, down 27%. Same thing with the Edwards Life Sciences Corporation. Again, we cannot use past performance to try to get gains in the market. It just doesn't work that way. And off on the side there, just for, I guess I'll call it for purposes of humor, you have JP Morgan Chase, which was fined $10 billion in 2013, and yet it was up 37% on the year. Again, picking individual stocks is a very dangerous game, and we don't endorse any particular company that will perform better than the market. Now, those are the individual stocks. What about countries? Well, for the entire year, the best performing market in the world was Greece, which probably surprises a lot of people, given that in 2011, Greece was the leper of the international community. Again, year to year, these things change. In the emerging markets category, what we see is Taiwan up on top, even above China. And then we see Peru down at the bottom of negative 30%. Again, emerging markets have had a pretty rough ride as of the last probably couple of years. But again, it's one of those asset classes that is very volatile. Sometimes it's going to be way up, sometimes it's going to be way down. Now, just for giggles, the USA up at number 4, which we haven't seen it that high in quite a bit. But again, US had a really good year. Not as good as Finland, Ireland, and Greece, but still pretty darn good. So what about constructing a portfolio based upon all of this knowledge? Well, if we look back in history, investors that had more in stock over the last quarter, 1 year, 5 year, and 10 years had better returns. Now, that doesn't mean that being all in stock or having a good amount in stock is appropriate for everybody. What you need to balance that against is that 10-year volatility number in the side. That 10-year volatility tells you how much these portfolios bounce over time. And again, the more stock you have, the more bounce. The worst thing an investor can do is to sell when the market's at an absolute low, because they will inhibit their growth and will never be able to fully recover what they had lost. So with a great year already completed, I think it makes sense to take a look back and see where we came from, see what the experts said at the beginning of 2013, and really delve into what we can do to make a difference in our portfolios. Now, I will freely admit, I love this chart because what this chart shows is how wrong Wall Street experts can be. At the beginning of the year, January 5th, 2013, the Wall Street Journal asked a bunch of different big players to guess what the S&P performance was going to be for 2013. And they all gave some kind of answer. They were all really wrong. Wells Fargo, if you look to the far right, thought the market was going to be negative. So they actually missed the mark by over 30%. On average, all of these companies missed the mark by around 20%. The best guesser, Citibank, was off by almost 15%. Again, these are the self-proclaimed gurus. These are the guys with the big MBA degrees, the ones that you would think can predict the market. But in reality, they just can't. Now, we can't fault the experts too much. After all, 2013 was in the top 21% of returns since 1926. That being said, it still falls not within the tails of the potential return, as we see 82% of returns since 26 have been between negative 10 and positive 40%. Now, we should just be happy we got that number, because if we look back in 2008, all the way to the left-hand side of that bell-shaped curve, we're definitely in the bottom 3% of returns since 26 when we look at 2008. But again, a little bit of an anomalous year, but not way outside of the norm. So what can we do about it as investors? Well, first of all, we can appreciate that past performance truly does not indicate future results. What we can also do is learn from the past and understand how our behaviors can impact our returns and our ability to retire in the future. What you see here is something called the cycle of market emotions. It is a behavioral finance tool that kind of helps us understand what we're feeling and why we're feeling it as the market's going up and down. So in 2013, we could be feeling optimistic or elated or have really great feelings, and that makes us think that we're willing to take on more risk. But that's not necessarily the case. And the problem is that there are books and speakers coming out that solidify our beliefs that we should be investing more and more and more. So if we see, you'll see at the bottom of the page it says Dow at 36,000. Well, that came out just around the peak of the market in 2007. And it made people want to invest even more, even though that was the area of greatest potential risk. Not that we knew that at the time. Similarly, if you see The Great Depression Ahead, or The Aftershock, which is a very popular book, which came out around the bottom of the market, it made people feel and kind of solidified their feelings that, yes, I should be selling right now because the worst is yet to come. And as it turns out, that was not the right choice to make. Not that we knew it at the time. Again, this kind of proves out why we need to try to tune out that noise and kind of listen to what research says. And that says, as long as we're in a balanced portfolio that's appropriate for what we need, that's where we should be. And so knowing what we know about the gurus and about how we feel about the market, what should we be doing? And the answer is focus on what you can control. And honestly, there's not a whole lot you can. You're not going to be able to control the market. You can't control what companies are going to put out in terms of press. You can't control, what editors of the New York Times are going to put in their headlines. What you can't control is how exposed you are in the market. What's your mix to stocks and bonds? Again, the more bonds we have, the more likely it is our portfolio will be more stable. And again, adding to your portfolio on a consistent basis helps again with that compounding, which is a really important piece of investing. And of course, being able to control how much you withdraw from the portfolio, how much you withdraw from your plan, also important in keeping those expenses low. So to recap, even the experts get it wrong most of the time. Now, the important thing is to try to control only what you can control, and that is how you invest. You're never going to be able to time the market or control it. So, again, as long as you're in a portfolio that makes sense for you, that's what's important. Best of success for 2014.